This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to the Luxembourg Fundcast. Okay, let's unpack this. Imagine a massive, complex piece of European Union legislation, years in the making, right? Designed to reshape how companies prove their real economic substance across the continent.
Mm-hmm. A huge undertaking.
And then, quite suddenly, it's just gone. Poof. What does that dramatic turn actually mean for the intricate world of international finance, particularly for us here in Luxembourg?
Well, that's exactly what we're digging into today. We're taking a deep dive into the rise and, I suppose, the unexpected fall of the EU's proposed anti-tax avoidance Directive 3. You probably know it better as the Unshell Directive.
That's the one.
And our insights today, just so you know, are drawn from a detailed analysis that was prepared for legal and financial professionals. It specifically looks at the implications for the Luxembourg fund industry.
Right. So this deep dive, it's really designed to give you a shortcut to understanding this pretty significant shift. We'll explore its ambitious design, why it was ultimately withdrawn, the core reasons, and crucially, what its demise truly means for demonstrating genuine economic substance now.
Which really sharpens the focus on existing frameworks, doesn't it? Like DT6.
Exactly. So get ready for some crucial clarity and maybe a few surprising facts along the way. Okay, so to really grasp the impact of it disappearing, we probably need to understand what ATAD 3 was actually trying to achieve in the first place.
Good starting point.
At its heart, according to the European Commission's own proposal, that's COM 2021-0565, it was basically an attempt to combat tax avoidance by setting harmonized rules against the misuse of so-called shell entities. Those undertakings with minimal economic activity that might be used for improper tax purchases.
Yeah, the classic letterbox company idea, although often more complex.
Right, and the ultimate goal was to create a uniform substance test right across the entire European Union.
That's right. And to identify these at-risk entities, ATAD 3 proposed this three-step filtering mechanism. They called it a gateway test, and it used a 2-year look-back period.
Okay, 3 steps. What were they?
Well, first, the passive income gateway. This tripped if more than 75% of an entity's revenue, though that was later tweaked down to 65% in proposals, came from passive sources. Think interest, dividends, royalties, income from immovable property, that sort of thing.
Okay, passive income, step 1.
Step 2, the cross-border gateway. This was triggered if over 60% later amended to 55% of its relevant income came from cross-border transactions, or if the majority of its assets were actually located outside its home country.
Makes sense, cross-border element.
And finally, step 3, the outsourcing gateway. This caught entities that primarily outsourced their day-to-day administration and, crucially, the decision-making on significant functions.
Right, so if an entity managed to pass through all 3 of those gateways, what then? What was the next hoop to jump through?
If you hit all 3, you were then required to report on specific minimum substance indicators in your annual tax return.
Minimum substance indicators, like what specifically?
We're talking at having its own premises for its exclusive use, also having at least one active bank account within the EU, and then either having a qualified local director with the authority to actually take decisions, or having a majority of its full-time employees being locally resident.
Okay, so quite prescriptive tests there.
Very prescriptive. And the consequences for failing the substance test, they were designed to be severe, intentionally so.
How severe?
A member state would have been forced to either flat out deny the entity a tax residency certificate or issue one with a very clear warning stamped on it.
Which sounds like it would cause major problems.
Oh, absolutely. This would essentially cut off access to benefits under crucial double tax treaties and key EU directives. The parent subsidiary directive, the interest and royalty directives.
So immediate practical impact.
Imagine immediate withholding taxes suddenly applying to payments. And even potentially being taxed on a look-through basis right up at the shareholder level. Plus, there was even a proposed minimum penalty, a fine of at least 5% of the entity's turnover for non-compliance.
Wow, 5% of turnover is significant.
Definitely designed to get attention.
But the directive had a critical flaw, didn't it? Something fundamental that didn't quite mesh with how the international fund industry actually operates. Our source material even calls it a fatal flaw.
That's a good way to put it.
It's rigid quantitative thresholds and this very prescriptive, almost box-ticking approach. They were just fundamentally ill-suited to the complex but entirely legitimate structures we see all the time in the fund world. Can you elaborate on that disconnect?
Yeah, this is really where the practical realities crashed headlong into the legislative intent. You see, for alternative assets, private equity, real estate, infrastructure, using special purpose vehicles, SPVs, and holding companies is standard.
It's just how deals are structured.
Exactly. And often these are centrally managed by an alternative investment fund manager, an AIFM. That's not avoidance, it's efficiency. Outsourcing the day-to-day administration, that's often about leveraging specialized expertise, getting economies of scale. It's usually not an indicator of abuse at all.
So the directive was maybe seeing smoke where there wasn't fire.
In many cases, yes. The directive's sort of one-size-fits-all approach, demanding things like exclusive use premises or dedicated employees for every single SPV within a complex fund structure, well, it would have imposed commercially unjustifiable costs.
Yes, wouldn't make business sense.
And immense administrative burdens, too. It really threatened to paralyze perfectly legitimate business models in an attempt to catch, perhaps a relatively small number of bad actors. It felt like a classic example of the proposed cure being potentially far more damaging than the disease itself.
So it stalled.
Yeah.
Which probably wasn't a huge surprise given those issues.
Well, the fact that the Unshell proposal was stuck in negotiations for over 3 years was definitely a big clue, wasn't it? It signaled a pretty deep-seated lack of consensus among the 27 member states.
And you need unanimity for tax stuff in the EU.
Precisely. Unanimous agreement is required. So the decisive moment finally came with the Economic and Financial Affairs Council, that's ECOFIN, their report 996025 in June 2025. That report basically provided the official verdict and the reasons for its withdrawal.
Okay, so after all that time, all that debate, why exactly was it pulled? What did the ECOFIN report say?
It boiled down to two primary reasons, according to the report. First, a significant overlap with the existing DECO 6 framework.
Okay. Duplication concerns.
Exactly. Many national delegations apparently concluded that Unshell's objectives identifying potentially risky structures could actually be achieved more efficiently just by clarifying or perhaps amending the existing DECO 6 rules.
Which avoids building a whole new reporting system, new IT.
Right. Avoids duplicative reporting obligations and those separate costly IT systems you mentioned.
Makes sense. What's the second reason?
This leads us to a kind of broader point. There was also this evolving EU policy shift towards what they're calling a tax decluttering and simplification agenda.
Try to streamline things.
Basically, yes. The aim is to enhance the union's global competitiveness. And introducing yet another complex, burdensome reporting layer like ATAD 3 was seen as running directly counter to that simplification goal.
So counterproductive.
Pretty much. And while the official sources don't explicitly detail, say, specific lobbying efforts from industry groups,
Which you wouldn't necessarily expect them to.
no, but it's clear that the consistent arguments coming from industry bodies, from advisory firms, highlighting the administrative burden, the disproportionate costs, the negative impact on legitimate investment structures, those arguments clearly resonated with member states during their long deliberations.
So ultimately, pulling ATAD 3 wasn't really a failure to tackle tax avoidance, was it? It seems more like a pragmatic recognition that the proposed method was just, unworkable and inefficient.
I think that's a fair assessment. The EU has, after all, spent the better part of the last decade building this really quite dense web of anti-avoidance and transparency rules already.
Yeah, we've got ATAD 1 and 2, multiple versions of DX reporting, the whole global BEPS project.
Exactly. Base erosion and profit shifting, or BEPS, all those layers exist.
So if we zoom out and look at the bigger picture, ATAD 3 was maybe designed to plug a specific perceived gap related to shell companies.
That was the idea. But the 3-year negotiation period really made it abundantly clear that this supposed gap was actually already largely covered or could be covered by other powerful tools, most notably DAX 6.
Right.
So the Council's decision to scrap a parallel duplicative system in favor of potentially refining an existing one, it seems like a logical, cost-conscious, and frankly pragmatic choice.
And maybe signals a shift in approach.
Possibly. It could signal a kind of maturation of the EU's tax agenda, moving from maybe a legislate at all costs mentality to a more considered legislate efficiently approach. And that's surely a crucial development for the fund industry, which, let's face it, bears the brunt of these compliance costs.
Absolutely. Okay, so with ATAD 3 now off the table, the spotlight swings, doesn't it? It turns with renewed intensity to an existing framework. And that's Council Directive EU 2018-8022, which most of us know as DAS 6.
Yeah.
Here in Luxembourg, That was transposed into national law back on the 25th of March, 2020.
Okay.
So remind us, what's the core purpose of DAC 6?
Its main purpose is really about enhancing tax transparency. It does this by compelling intermediaries, think advisors, banks, sometimes lawyers, or in some situations, the relevant taxpayers themselves, to report potentially aggressive cross-border tax arrangements to the authorities.
Aggressive arrangements, okay.
The real core of DUS 6 lies in its hallmarks. These are specific characteristics or features of an arrangement that can trigger this reporting obligation. You can think of them as sort of red flags that tax authorities specifically want to know about.
Right. These hallmarks sound critical then. Can you walk us through the different types? What sort of arrangements are they targeting, especially as they apply here in Luxembourg under the law?
Certainly. The DOC 6 hallmarks are grouped into categories, each pointing to different types of perceived risks or structures. For instance, Category A covers generic hallmarks. These are often linked to what's called the main benefit test, or MBT, which we should probably come back to.
Okay, MBT, got it.
These Category A hallmarks include things like arrangements where confidentiality clauses are tied specifically to the tax advantage, or where advisory fees are contingent on obtaining those tax benefits.
Right, classic signs perhaps.
Then you have Category B. These are specific hallmarks, also generally linked to that main benefit test. Examples here might include schemes designed to acquire loss-making companies purely to reduce tax liabilities, or converting income into lower-taxed capital or gifts, or certain circular transactions.
Okay. What about Category C?
Category C deals with specific types of cross-border transactions. Some of these are subject to the MBT, like making deductible payments to an associated enterprise based in a low-tax jurisdiction. But others are automatically reportable, regardless of the MBT. Things like claiming double appreciation on the same asset in multiple countries, or claiming double tax relief.
Ah, so some are automatic triggers.
Yes. Then there's Category D, which is particularly relevant for us in the fund industry. This targets arrangements designed to undermine reporting obligations under things like the Common Reporting Standards, CRS, or arrangements that deliberately obscure beneficial ownership. Transparency issues, basically.
Very relevant. And the last one, Category E.
Category E zeroes in on transfer pricing. It covers things like using unilateral safe harbor rules, the transfer of hard-to-value intangible assets between group companies, or certain intragroup restructurings that result in a significant shift of profit.
Okay, a broad range of flags there. You mentioned the main benefit test, the MBT, a few times. That sounds like a key filter for many of these hallmarks. How does that actually work in practice?
Yes, the main benefit test is indeed critical for categories A, B, and some of C. It's considered met if obtaining a tax advantage is one of the main benefits that a person can reasonably expect from the arrangement.
One of the main benefits, not necessarily the only main benefit.
Exactly. That's a key distinction. And importantly, it's not always black and white. Crucially, the Luxembourg guidance suggests that if a tax advantage is consistent with the actual object and purpose of the relevant tax law, it might not meet the MBT, even if it is a benefit.
Ah, so there's room for interpretation there. Legal judgment.
A significant amount. It introduces a vital element of legal interpretation and judgment. Now, reporting itself in Luxembourg, that's done via the Magische portal, and there's a strict 30-day timeline from when the reporting obligation is triggered.
30 days is tight.
It is. And another important point for Luxembourg. Lawyers, auditors, and chartered accountants here are bound by legal professional privilege. This often means the reporting obligation shifts away from them, perhaps to other intermediaries involved, or sometimes directly to the taxpayer themselves.
That sounds like a really significant shift in risk, doesn't it? Moving from what might have been a clearer, albeit burdensome rule under ATAD 3 to something requiring much more judgment under DAC 6.
Absolutely.
So, while the industry might have celebrated ATAD 3's demise, you could argue that compliance with DAC 6 is actually a more complex, maybe even a more perilous exercise. Why is that the case?
Well, I think a key aspect here is that DAC 6 demands really deep, principles-based legal judgment. It's not about just following a simple checklist. ATAD 3, for all its faults, was prescriptive. The analysis, yes, it would have been burdensome, but relatively binary. You meet the threshold or you don't.
Right, tick the boxes.
Exactly. DAC 6, by contrast, is highly interpretive. Concepts like the main benefit test are far from clear-cut. Deciding if a tax advantage is one of the main benefits or whether it's consistent with the object or purpose of the law, that requires sophisticated legal analysis.
So more subjectivity.
Definitely. And that subjectivity places a significant onus on intermediaries and taxpayers to meticulously document their analysis, to really justify their positions. Because the risk of getting it wrong isn't just a potential financial penalty.
There's more.
Well, the very act of reporting an arrangement under D6 can, in itself, signal a red flag to the tax authorities. It might increase the chances of scrutiny or even trigger an audit down the line. So navigating DAX 6 is less about ticking boxes and much, much more about constructing a solid, defensible legal argument.
Okay, that makes sense. Now, we know ATAD 3's expected compliance costs were a huge factor in the opposition to it. But DAX 6 clearly isn't free either. It represents an ongoing, significant investment for the industry, doesn't it?
It certainly does. It's not a one-off cost.
So how should funds be thinking about this? Maybe not just as a cost to be minimized, but perhaps as an investment in their resilience and their reputation.
That's a really crucial perspective to take now. The costs involved, yes, they exist. They include internal costs, time spent by in-house teams, but more significantly, often external costs for specialist advice and technology.
What kind of external costs?
Fees for legal and tax advisors, obviously. To assess transactions against those hallmarks we discussed, to provide formal opinions, perhaps assist with the technical aspects of reporting via MyGuichet, and also, potentially, investment in technology solutions designed specifically to track and manage DT6 obligations across complex structures.
And how are those services typically priced? Is there variation?
Oh, yes. You see different models. Some providers might offer free initial assessment tools, sort of as a lead generator for their paid advisory work. Others compete on having transparent, perhaps fixed fee models for certain services, contrasting with more traditional, maybe opaque variable pricing.
But the core service is similar.
The core service offering is generally consistent. Risk assessment, helping design governance frameworks, training staff, maybe implementing or recommending technology. The ultimate price tag, of course, reflects the complexity of the client's operations and the level of risk mitigation they need.
And what's the stick? What's the cost of not complying properly?
Well, in Luxembourg, the potential penalties are significant. Failure to report, reporting late, or providing inaccurate information under DAX 6 can trigger fines of up to 250,000 euros.
Per infringement.
Per infringement, yes. So that stark financial risk really makes the investment in robust compliance procedures look like a pretty clear and rational business decision.
Okay, so those potential fines are definitely a strong incentive. But looking beyond just avoiding penalties, is there a more proactive benefit here? How does strong DAX 6 governance actually add value for funds in this new post-ATAD 3 landscape?
Absolutely. There's a definite value add beyond just avoiding fines. In this post-Unshell environment, how a fund approaches its DI6 governance has really evolved beyond being just a simple compliance checkbox.
How so?
It's now arguably a key element of its value proposition to investors, and it's a critical component of its overall risk management framework. Think about it from an investor's point of view. Institutional investors, particularly, are increasingly sophisticated. They're highly averse to tax compliance risks and any associated reputational damage. So a fund manager who can clearly demonstrate a well-documented, proactive, and robust process for managing D6 obligations, that signals something important to those investors.
What does it signal?
It signals that their capital is being managed within a framework of high integrity and low risk, which stands in very sharp contrast to a fund taking a purely reactive approach, maybe risking misreportings, penalties, audits, all of which can negatively impact fund performance and seriously erode investor confidence.
So it's about trust and stability.
Exactly. Therefore, the budget allocated to DAX 6 advisory and technology shouldn't really be viewed as just a sunk cost. It's genuinely an investment in operational resilience, in risk mitigation, and ultimately in the fund's brand reputation.
That makes a lot of sense. Now, going back to ATAD 3's withdrawal, the industry reaction was described as widespread relief, even a significant win. Why was this such a big deal for them? What was the core issue?
Well, the core objection, the fundamental worry, was that if ATAD 3 had been implemented as proposed, it could have resulted in the loss of tax benefits for entirely legitimate asset holding companies.
The very structures needed for funds.
Precisely. These are often essential components for standard, recognized, tax-efficient fund structures. The industry's consistent position, which they articulated quite clearly in formal consultation responses and discussions, was that the existing measures like ATAD 1, ATAD 2, and crucially DAN 6 should be properly enforced and evaluated before adding a completely new, potentially duplicative and burdensome legislative layer.
And that argument ultimately won out.
It seems so. That argument proved persuasive and ultimately carried the day with the member states in the Council.
So how does this withdrawal specifically play into or reinforce Luxembourg's own competitive advantages as a fund domicile?
Well, ATAD 3's very rigid quantitative substance tests would likely have been particularly damaging for Luxembourg's specific fund ecosystem.
Why Luxembourg specifically?
Because our ecosystem is built on having a diverse and flexible range of legal vehicles available. Most notably, the tax-transparent partnerships like the Société en Commandite Simple, the SCS, and Société en Commandite Spéciale, or SCSP. You need to state the full name first.
Right, the SCS and SCSP. The Special Limited Partnerships.
Exactly. These vehicles are highly effective, globally recognized tools for international fund structuring. However, they often don't naturally have dedicated premises or employees at the partnership level itself.
Because the functions are elsewhere.
Precisely. Management and operational functions are properly centralized at the level of the Alternative Investment Fund Manager, the AIFM, or delegated to service providers. ATAD 3 didn't easily accommodate that standard efficient model.
So the withdrawal removes that specific threat and reinforces Luxembourg's key advantages. What does that mean in practice now?
It means the focus, thankfully, returns to a more principles-based assessment of substance, which plays directly to the jurisdiction's established strengths. Such as, firstly, a really sophisticated ecosystem of experienced advisors, legal, tax, corporate, who are adept at navigating complex principles-based rules like DC6. Secondly, a flexible legal and regulatory framework that allows for the creation of structures that have genuine commercial rationale. And thirdly, deep investor and lender familiarity with Luxembourg structures, which provides crucial stability and predictability.
You know, in a way, that long, arduous debate over ATAD 3, it almost inadvertently stress-tested and perhaps even validated the Luxembourg model, didn't it?
That's an interesting way to put it.
The directive proposed this single, very simplistic definition of substance for the entire EU. But Luxembourg's success is built on offering a sophisticated toolkit, options tailored to different investment strategies.
I think that's right. The critical point to note here is that the whole debate really forced the industry, and maybe more importantly the member states, to confront the reality that there just isn't one single definition of good substance that fits every legitimate business case.
Different needs for different structures.
Absolutely. The substance required for, say, a large real estate holding company is fundamentally different from the substance needed for a venture capital fund's SPV investing in multiple small startups. By rejecting that rigid one-size-fits-all ATAD 3 model, the EU has implicitly endorsed a system where substance is assessed more on a case-by-case basis, considering the overall commercial rationale.
And that's an environment where Luxembourg thrives.
It's precisely the environment in which Luxembourg, with its deep pool of legal and tax advisors and its flexible corporate law, really excels. Now, while the separate ATAD 3 directive is dead and buried, its core concepts might not be gone forever.
Oh, how so?
Well, it was explicitly suggested during those ECOFIN discussions that the underlying policy goals of Unshell could potentially be achieved just by amending the existing DAX 6 framework.
Folding the ideas into DAX 6.
Potentially. This means that hallmarks related to things like outsourcing, passive income levels, cross-border activity concentration, the very things ATAD 3 targeted, could perhaps be integrated into the existing DAX East reporting framework in the future.
So that's something to watch out for.
Definitely. This remains a key area for you listening to monitor very closely. The ghost of Unshell might reappear within DDAL 6.
Okay, good warning. And it's also critical, isn't it, to place this whole development in the wider context of global tax reform.
Absolutely crucial.
We have the ongoing implementation of the OECD's Big BEPS 2.0 project, particularly Pillar 2, the global minimum tax rules, that continues to reshape the entire international landscape.
It really does.
And all this just reinforces the central message, doesn't it? The pressure for tax transparency, the global fight against base erosion and profit shifting. That's not diminishing.
Not at all. If we zoom out again, the specific tools might change. ATAD 3 gets shelved, maybe DT6 gets amended, but the fundamental direction of travel seems pretty constant. More transparency, more substance required.
Right. So Looking specifically at the current outlook for Luxembourg, say, here in mid-2025, what's the picture?
Overall, the picture seems to be one of resilience, actually, and quite proactive policymaking from the government. Despite various external headwinds the global economy has faced, Luxembourg's financial sector remains robust.
We're seeing growth recover.
Yes, growth is projected to recover, and assets under management have continued to hit new highs, which is remarkable. And importantly, the government is actively pursuing policies to enhance competitiveness.
Like what?
Well, for instance, a reduction in the corporate income tax rate confirmed for 2025, and also various new measures designed specifically to attract and retain high-skilled international talent, which is vital for the sector.
Not putting it all together.
The withdrawal of ATAD 3, combined with these forward-looking domestic policies, it really positions Luxembourg to build on its existing strengths. It reinforces its ambition to continue being a leading, stable, and innovative financial hub for the future.
Okay, so we've taken quite a deep dive there into the fascinating and maybe slightly convoluted story of the EU's Unshell directive. It really is a compelling reminder, isn't it, that even the most ambitious legislative proposals can get shelved when they run up against practical realities in existing frameworks.
Absolutely. And just to maybe reiterate our two main takeaways for everyone listening. First, the ATAD 3 Unshell directive is officially off the table as of June 2025. It was abandoned primarily due to what was seen as unworkable complexity and a counterproductive overlap with the existing Day 6 framework.
Takeaway number 1, Unshell is gone.
Takeaway number 2. This is definitely not a free pass. It doesn't mean substance doesn't matter. Instead, the focus intensifies significantly on Day 6, a more nuanced, more principles-based regime. For the Luxembourg fund industry, this really means the need for demonstrable economic substance and sophisticated legal navigation is arguably more critical than ever before.
So, what does this all mean for you? Well, even as specific directives like ATAD 3 are withdrawn, that global push for tax transparency and genuine economic substance, it's clearly an ongoing evolution. The specific forms might change, the directive numbers might shift, but the underlying pressure remains. So the question for you is, how will you ensure your structures are not just compliant today, but genuinely future-proofed against the inevitable next iterations of anti-avoidance measures? Definitely something to ponder for your own deep dive. This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.